Have you ever wondered how investors manage risk and optimize their portfolios? In the world of investing, risk and portfolio management are two cornerstones that help steer the ship towards steady financial growth. They are like two sides of the same coin, each playing a vital role in the investment journey. Risk management is all about playing it safe while making the most out of opportunities. Investors do this by diversifying their investments across various sectors and asset classes. They also use financial derivatives like options and futures as a hedge, a kind of insurance against unforeseen market fluctuations. But perhaps the most critical part of risk management is maintaining a disciplined investment approach to steer clear of emotional decisions that could potentially derail their investment goals. Now let's talk about portfolio management. This is where investors create a balanced investment portfolio that aligns with their risk tolerance, investment goals, and time horizon. It's like creating a financial blueprint that guides you towards your financial goals. This involves asset allocation, regular portfolio rebalancing, and performance monitoring. These strategies sound simple, but their application can sometimes be complex. Let's dive deeper. To better understand these concepts, consider a study conducted in Delhi on the risk perceptions and portfolio management of equity investors. The research was based on responses from 100 individuals, revealing that investors typically have a moderate to high level of perceived risk. This level of risk perception is a crucial factor that influences the investment decisions they make. Interestingly, the study found that there was no significant relationship between gender and investment choices. This suggests that risk tolerance does not hinge on gender, debunking some common stereotypes. So, whether you are male or female, your investment choices are likely to be influenced more by your individual risk perception and not your gender. One of the key findings of this study was the impact of experience in the stock market on risk appetite. It was observed that as investors gain more experience, they tend to take on more risk. This trend can be attributed to the increased familiarity and understanding of the market dynamics that come with experience. Over time, seasoned investors develop the ability to navigate the ebbs and flows of the stock market, which in turn boosts their confidence to take on higher risk. However, the study also highlighted a point of concern. It found that the moderate risk perception among investors could be attributed to average financial awareness, particularly among the younger age group of 18 to 40 years. This implies that despite having a basic understanding of financial concepts, this knowledge is not sufficient to increase their risk-taking capacity. This case study provides valuable insights into how investors manage risk and optimize their portfolios. It underscores the importance of experience and financial education in shaping investment decisions. It also highlights the need for investors to continually enhance their financial knowledge and stay updated with market trends as they strive to build a balanced and optimized investment portfolio. Now, let's delve deeper into risk management. Imagine you're on a high wire, walking between two towering skyscrapers. How do you manage the risk? You might use a safety harness, practice beforehand, or even have a net below you. Similarly, when it comes to investing, there are ways to manage the inherent risks. One of these is diversification. Just as you wouldn't put all your eggs in one basket, you shouldn't put all your money in one asset or one sector. Spreading your investments across various sectors and asset classes can help cushion the impact if one of them takes a hit. Another strategy is hedging. Picture this. You're on a boat in choppy waters, but you've brought along an anchor. The anchor here is akin to financial derivatives, like options and futures. These instruments allow you to protect your portfolio against potential losses, acting like an anchor that can help stabilize your boat amidst the stormy seas of the market. Lastly, the disciplined investment approach. It's like sticking to your workout regimen even when you don't feel like it. Similarly, investors must stick to their investment strategy and avoid making decisions based on emotions. Market trends can be as fickle as the weather, and emotional responses to these fluctuations can lead to poor investment decisions. Remember the study we mentioned earlier? It showed that experience in the stock market significantly influences risk appetite. This suggests that a disciplined approach coupled with experience can lead to more informed risk-taking. So whether you're walking on a high wire, sailing through stormy seas, or investing in the stock market, managing risk is crucial. As you can see, managing risk involves a combination of strategies and a disciplined approach. Now, let's turn our attention to portfolio management. This is the art and science of making decisions about investment mix and policy, matching investments to objectives and balancing risk against performance. It's about creating a balanced investment portfolio that aligns with the investor's risk tolerance, investment goals, and time horizon. The first step in portfolio management is asset allocation. This involves dividing your investment portfolio among different asset categories, such as equities, bonds, and cash. The allocation depends primarily on your investment goals and risk tolerance. For instance, if you're a risk-averse investor, you might want to invest more in bonds and less in equities. On the other hand, if you have a high risk tolerance and long-term investment goals, you might want to invest more in equities. Once the assets are allocated, it's not a set-it-and-forget-it affair. Regular portfolio rebalancing is the next crucial step. This involves periodically buying or selling assets in your portfolio to maintain your original or desired level of asset allocation. For example, if equities perform well and their proportion in your portfolio increases, you might need to sell some equity and buy bonds to maintain the balance. Lastly, performance monitoring is an integral part of portfolio management. This involves regularly reviewing and evaluating the performance of your investments. Are they meeting your expectations? Are they in line with your investment goals? If not, you might need to reconsider your asset allocation or investment strategy. Let's not forget that portfolio management is not a one-size-fits-all approach. It's unique to each investor based on their specific needs, goals, and risk tolerance. It's an ongoing process that requires time, knowledge, and discipline. A well-managed portfolio can align with your investment goals and risk tolerance, leading to potentially better investment outcomes. So, effective risk and portfolio management are key to a successful investment journey in the equity markets. Remember, diversifying your investments across different sectors and asset classes, using financial derivatives for hedging, and maintaining a disciplined approach are all part of managing risks. When it comes to portfolio management, creating a balanced portfolio that aligns with your risk tolerance, investment goals, and time horizon is crucial. Regular portfolio rebalancing and performance monitoring are also integral to this process. The case study we discussed earlier underlines the significant impact of stock market experience on risk appetite. As investors gain more experience, they tend to take on more risk. Interestingly, the study also found no significant relationship between gender and investment choices, implying that risk tolerance isn't influenced by gender. By understanding and applying these principles, you're equipping yourself for a more secure and potentially profitable investment journey in the equity markets. If you found this information helpful, remember to like, subscribe, and share our content. Your support keeps us going, and we'll continue to bring you valuable insights. Keep watching our videos for more financial tips and strategies.